Hey everybody, Jordan Schwartz here, partner with Strategic Wealth Designers. We're doing our webcast live. So let's go ahead and hop in. What I wanted to do kind of before is we're having a number of people. I'm looking at the attendees list right now. We got a bunch of people, a few hundred that are going to be on here today. So we want to give them some time to get in. So we've got a short video we want to share with you. Let me go ahead and click on this, and then I'll start the video, and we'll be back in about 5 or so minutes.
Yeah, he's our financial expert.
What if my parents named me the expert?
Yeah, the expert. I mean, that would be all-encompassing, right?
Yeah.
Well, we want to talk about interest rates. We just heard that the Fed's dropped rates again. And I know a lot of people think, yay, what does that mean?
Well, it's really interesting. The Fed uses interest rates by lowering them or raising them based on how they perceive the economy is doing.
Yeah.
So when they lower rates like they just did, oftentimes that leads to them thinking the economy needs a little bit of a kickstart, a little bit of a boost, because it's kind of struggling a little bit.
Okay.
A lot of people are wanting to refinance their homes, maybe start getting some larger loans that they've been putting off up to this point. When they raise rates, they're doing that because they think the economy is getting a little unruly. So what's really interesting about it is it kind of points to what the Fed and how they're viewing the economy actually is.
Well, talking about the housing market, where does that stand right now with the interest?
What are you telling your clients who have to be ringing the phone off the wall?
Well, I think a lot of people are shocked to the idea that the market moves in two directions, not just one. I think for a long time we've gotten a little complacent with the idea that the stock market only goes in one direction. So what I'm telling my clients right now, if what's going on right now makes your stomach churn a little bit, again, with the coronavirus, it might be what we call what we call black swan event, just something unexpected you just can't predict. If it's making your stomach churn right now, maybe it's a time to re-look at your allocations inside of your portfolio, meet with a professional, and really look and make sure you have the proper asset allocations. Again, if the market goes down a lot in one day and you get really uncomfortable or you don't like seeing those losses, you may want to shift some of those assets to more safer assets or building strong safety nets.
So there is no simple.
We have seen historic plunges and nothing seems to be easing fears. The emergency rate cut last week, just today the Fed pumping tens of millions of dollars into the financial system to try to ease this panic. Have you been surprised at the numbers, and where do you see the market going over the next few days?
Definitely a little bit surprised, but the market loves predictability, and it's been anything but that for the last few years. You know, we had tariffs, we had impeachments, now we have the coronavirus, then we had oil prices dropping, and so anytime something happens negatively in the globe, the market tends to react with a knee-jerk reaction. And so, of course, there's just a major sell-off, and I feel like it'll probably get a little bit worse before it gets better.
How low do you think things will go before we see a turnaround, and how long do you think it'll take?
Well, there's no way to know. I do think things will stabilize. I feel maybe when the weather gets better and the coronavirus starts to, subside, then that will help. But, there is just no way to know. What's the next thing? Elections around the corners. So.
Right. Always something.
Dustin Stanley with Strategic Wealth Advisors joins us to talk about finances. The Dow ended up over 5% higher, but that's not much when we look at what we lost yesterday. But Dustin, was this the right move? What is this going to do to help people at home? What should they take away?
I think the headline is great. I mean, $1 trillion stimulus into our economy, that's awesome. But if you think about the GDP of this country, that really buys us less than a month. I mean, we're over $20 trillion per year as GDP. So if everything shuts off and we don't have businesses running and people spending money, $1 trillion really isn't a whole lot of money.
The stock market is it's a forward-leading indicator. It's definitely pricing in a recession right now. Let's just assume we're going into a recession. What do people need to know to prepare? A recession means you're out of work. What can they do?
Well, I hope you've met with your advisor prior to these things happening. But if not, then it's not too late to make adjustments, make changes. That doesn't mean go out and sell everything off at a huge loss, but you need to make sure and have safety nets in place.
Another steep drop today on the market. How do we actually look at this from a financial and an emotional standpoint in terms of what this means for our money long term?
the key thing to do is have a plan. So if you know why you've made decisions, it's going to allow you to limit the emotions of how you react here. So I would say if you don't have a plan, you need to have a plan. You need to see an advisor. You can, if you're comfortable doing it yourself, you can come see us. We have an office in Fishers and Plainfield, but that will stop you from making highly emotional decisions. And if you've got too much risk, you can make some adjustments. You don't want to freeze. However, you want to be careful how you handle the situation. Not overly emotional, careful, smart adjustments based on what you own.
Now, Mike, I know you're hearing from a lot of your clients as well, and I'm sure a lot of clients are saying, are we...
All right, everybody, we are back. Looks like most everybody who is on the webinar for today is currently here. As I said before, I'm Jordan Schwartz, partner with Strategic Wealth Designers, and I know we have a lot of existing clients on here, maybe folks who have been to an event of ours before, something like that. So if you don't know much about us, we've got offices all over the country: Louisville, Kentucky, Lexington, Kentucky, Cincinnati, Ohio, Denver, Colorado. So we're all over the nation. But we wanted to do something different for you all, which is a webinar just like this. And the reason why is we're in crazy times right now. What better to do when you're home during the quarantine but to get your investments under control and get them situated. A couple things kind of as we get started. On your right-hand side, I see most all of you are typing into the chat. As we go through things today, I want this to be as interactive as possible. I know you all can see me, but I can't see you. So when I ask questions or do things, I'd love for you all to type in your answers. Another thing also, I'm going to give everybody like 2 seconds. If you don't have something to write with, get something to write with. This should be super helpful. I want to give everybody a lot of really good information and value out of today. So kind of what the focus of today is what's happening in the market right now. I know whether or not you're a client of ours, maybe you've seen something of ours before, or you're just looking for clarification and all of the uncertainty of the market right now. This should be helpful for everybody. If anyone is wondering if I'm a little nervous right now, my mother-in-law is currently on here before, and I don't think she's ever seen me do an event like this before. So I'm just a little nervous because my mother-in-law is watching me. I know, Cindy, you'll tease me after this. So let's go ahead and hop in. I'm going to pull up over here. We've got some awesome slides for you guys. So let me pull this up. So let me start the presentation, and we'll get this cooking. Okay, so the Corona crisis, what to do when the market crashes. We are in uncharted times right now. I don't think anybody could have predicted the gravity and the impact of what's happening in the market right now. So what my goal is for today is to talk about what's happening, talk about where we're going, some of the macroeconomic trends of what's taking place, and then more importantly, get everybody towards a better position, offer existing clients reassurance of the current strategy we have in place, or new people out there, maybe challenge some of the strategies you have in place and maybe cause you to reevaluate what you're currently doing. So if we go right here, actually, let me go back real quick. Hopefully you didn't see that too much. So if you think of somebody's portfolio and you had to guess, and I want you all to put this up in the chat, but if you had to guess, there's 3 main driving forces that impact the outcome of your retirement in your portfolio. Those 3 different ones are asset allocation, security selection, and market timing, right? Asset allocation, security selection, and market timing. If you all had to guess out of those 3, and I want you to put this in the chat, which of those 3 do you think makes the biggest impact on your retirement? So everybody type those in. The 3 are asset allocation, market timing, and security selection. So everybody go ahead and type those in. I want to see the answers pour in. This should be really interesting as we go through things. Okay. Seeing your all's answers come in. Okay. Asset allocation. Seeing some security selection. Okay. There's a few there. A lot of y'all are coming in. So it's really interesting. Yeah, there's a bunch of good answers in there. Okay. So if we go to this next slide right here, I think a lot of you maybe saw the answer. But if we look, basically the 3 different ones, asset allocation, market timing, security selection, 92% of the success of your retirement is based on asset allocation. This is data that is unanimously agreed upon in the investment community. These aren't studies we've done. It's all of the studies basically that are out there. And what they show you is that asset allocation dictates about 92% of the time whether or not you succeed or fail in retirement. Here's what's interesting. And a lot of you I saw put in market timing. That's basically when you buy and sell. Here's the problem with market timing. You got to be right twice. When you buy, when you sell. that makes it so unbelievably difficult where over times you don't really get a predictable feedback or system as to whether or not you're going to be right consistently. Look at hedge funds for this year. They're getting absolutely buried with what's going on in the market right now. Market timing, it doesn't do it. As we're going through things too, as an aside, I like to move around a lot. For those of you who are clients or know me really well, I have a hard time sitting still. So if I'm moving, you might see my arms moving around. I'll try not to stand though. Okay, security selection is what stocks do you pick? That's if you got lucky with Apple or Amazon. But what's interesting, 92% of the time, your portfolio success is determined by asset allocation. Now, I know for clients of ours, we've talked about a proper asset allocation, but here's what I would imagine anybody here who is not a client of ours has. You got 3 things in your portfolio: cash, bond funds, stock funds, that's it. Mostly it's in mutual funds and your IRAs and 401ks. Cash doesn't grow. Now, when we think of bond funds, the term safe is a relative term, right? Bond funds, they're safer than stock funds. Y'all should put this in your notes too. Bond funds are safer than stock funds. They are not all the way safe. So if you look at a bear market like a 2008 or the Corona crisis, they don't fall as much as stock funds, but they still fall. The third option that you got are stock funds. Those have all the risk of the market. So as the market's going through its ups and downs, we're riding the waves of the volatility with it. That's why having a properly allocated portfolio is so unbelievably imperative to the outcome of your retirement. So if we go to this next piece right here, this is really interesting, and I want to talk about the stock market and its cycles because it's really interesting. Historically, every 7 to 10 years, we have a market correction. So on average, it takes about 7 years for us to get back to where we're at, and we've got 100 years of data. But on average, 7 years on the high end, it has literally taken as long as 16 years. The last time it took 16 years to get back to where we were at, 1966 to 1982. It's a 16-year period in the economy where there was no growth. So you think about it, let's say we take a dollar, drop it in the market in 1966, let it ride. We go in, we take all that money out of the account in 1982. That was a 16-year period in the economy where there was no growth. So when you take that original dollar out of the account, that original dollar is worth $1. Keep in mind, too, I'm not including taxes, fees, inflation, underperformance, any of those other variables. If you throw that in the equation, what do you think that dollar was worth? A whole lot less, probably like 10, 20, 30, 40, 50 cents. So the reason why I bring that up is that with what's taking place right now, it's really easy to ignore your investments. Does anybody know what the first stage of grief is? Type that into your all's answers. I want to see. But what's the first stage to grief? Okay. Yeah, I saw a couple people type it in there. Denial. Right now, there is a huge problem of investors denying what is happening in the market. The easiest reaction is to ignore what's happening and tell yourself, or your advisor tells you, just ride it out. Happy days are ahead. It'll bounce back. Market's going to the moon. You don't sell it. It's a paper loss. Right now, for a lot of people, yeah, I'm seeing a lot of answers on delay. Everybody put denial. But right now, for a lot of people, it's 1 to 2 years for recovery. I know that's not the fun answer to hear. If we don't fix it and stop it in its tracks, we could follow the pattern of history, which is 7 to 10 years. And the problem with that is that that period of time, if you're within 10 years from retirement, the impact is quite honestly devastating. So if we come right here, this is really interesting. I love showing this. Basically what this is this shows the emotional roller coaster of the stock market. And simply put, what we're seeing right here is how people react to the market based upon action. See, what's really interesting is that whether or not we want to admit it, investor psychology plays an unbelievable impact on the outcome and the success of our retirement. That's why security selection or market timing, those are usually emotional decisions that lead to bad outcomes. Asset allocation is a more disciplined approach. We save money to think less about money, not to think more about money. So if you look at this chart right here, it's kind of funny. But you start with optimism, you hit excitement, and then thrill, which is where a lot of people were a month ago. Or 2 months ago, or 3 months ago. They're at thrill, and then we hit euphoria, which is the point in time where we all tell ourselves, wow, I am a genius. What happens? It's the maximum point of financial risk where we should be conservative and secure, and then boom, market correction takes place, and then we have anxiety and we have denial. And that's where a lot of people are at right now. Denial. Then we hit fear, desperation, panic, capitulation, where most people say the markets aren't for me, and they sell everything and they move it to cash, where we want to buy low and sell high. Most people buy high and sell low. And at that point of maximum financial opportunity, that's where our new clients are in the position of right now, where we're waiting for a good buying opportunity. The place where we have the best opportunity, people tell themselves, maybe the markets aren't for me. And we ride this cycle round and around and around in 2000 and 2008. Right now, we're riding this cycle. And the reason why I bring this up, whether or not you're working with us right now, this is probably one of the single biggest thing that is causing you up to this point to make bad investment decisions in your portfolio. It's allowing your emotions to govern the impact of what your portfolio is doing. And what's so important about this is we've got to step off the roller coaster ride and see where we're at. And the reason why I bring this up, if you are in that denial stage, which a lot of people are, that tells you where we're at in the cycle, there is still a lot more that things can go down. And it's much easier to tell yourself it'll bounce back, happy days are ahead. But what I want to say for everybody out there, if your money's at a loss right now, if things are floundering, there are ways to get yourself in a much better position. Yeah, it's maybe 1 to 2 years of recovering what you've got, but it's much better than 7 to 10 years. So if we come over here, this is what's really interesting. My background is in macroeconomics. I've studied it a ton. I like it. It's boring for most people. So what I want to do is I want to kind of talk about 3 different main macroeconomic trends. If you see me looking down, I've got a bunch of notes written out just to make sure I could give you all really relevant, good information. But first and foremost, that top one right there is what's called feedback loops. Now, what's happened is the coronavirus is crazy. And there's 2 feedback loop components to what's taking place. First and foremost, coronavirus impacts the stock market. So what you saw is that there was a lot of panic selling and liquidations. People were selling all their money because of the coronavirus and the fear of that. What's really interesting, this largely resembles the Great Depression. And whenever people were literally doing the bank runs, right, they were going to the banks, pulling all the money out of those accounts because they were afraid. The same thing is literally happening right now in 401ks. We're having 401k runs. And what's happening is coronavirus impacts stock market. The problem is now the stock market is impacting the economy, right? What we've got to have the distinction of is that the stock market isn't the economy, it's a part of it, but it can impact it. What's happening with the coronavirus now, unemployment's getting worse. If you ask an economist, what's the single worst thing you could do to the economy? They're going to tell you this: stop the economy for 2 months. It's what we're about to do. So the problem with that situation is that if we stop the economy, about 70% of our entire economy is based on consumption, buyers and sellers. Well, if there's no buyers and sellers doing different things with what's happening in the economy right now, we don't really have the opportunity to consume or do anything. I mean, we're kind of stuck in our houses. So the problem that's associated with that is now the coronavirus has impacted the stock market. The stock market has impacted the economy. And the thing we have to keep in mind is, too, the Fed right now is trying to use monetary policy to fight a virus. And you can't use monetary policy to fight a virus. If you look at the decisions the Fed has made recently, they have talked about sending $1,000 to everybody's mailbox every single month. They've talked about a $1 trillion stimulus package. They've also talked about, too, a $700 billion quantitative easing package. And simply put, what quantitative easing is, it's how much you're, it's a good way of putting it. It's how much money the Fed is pumping into the economy. See, the Fed's got 2 tools that they can use to get us out of a recession. They can lower interest rates and they can print money. Interest rates are at 0 right now. They're as low as they can go without going negative. And then also the Fed's trying to print money. The problem is they're using tools where the virus has to run its course. And the market likes certainty. Does the coronavirus give the market certainty right now? No, absolutely not. So what's problematic about the situation is that we have no certainty in the market when it's craving certainty. And what people are starting to notice and recognize is that the Fed is making these decisions to ease the blow of the drop because they can't stop it. But anybody out there who's watching, the market's fallen almost the fastest it ever has. And it's not done yet. With this level of momentum, it's very hard to correct the course on something like that. And that one below that is the R word. And my intention is to not be negative or upset anybody right now. I'm a very positive person, but we've got to know what's happening right now. The R word, it's recession. Right now, the Fed printing $1 trillion to $2 trillion, pumping it into the economy. That represents, like Dustin was talking about in the video before, that only represents about 10% of our GDP in a year. It's about $20 trillion GDP every single year that we go through. $2 trillion is basically 10%. It's a little bit more than a month. Well, what's really tricky about that situation is that we're trying to use tools of monetary policy when the virus has to run its course. And the reason why I bring this up is if you're a client, we've already called you or we will be calling you in the next few days as we've been. If you're not hearing from your advisor right now and you're with somebody else right now, that's a big red flag. It's a huge red flag because it's not done falling. Earnings haven't come out for this quarter. Earnings haven't come out for the next quarter. We haven't even had a million cases globally. They're talking about in the US, what I think it was 75 to 150 million cases of coronavirus. We don't even have a million globally right now. So that tells you how early we are into this thing. And we don't know how long it's going to take for businesses to resume. Look across the country. Countries are shutting things down, saying don't do anything for 2 or 3 weeks. I don't know necessarily if at the present moment that's enough. I think what's happened is you have the very strong possibility, if we're kind of already there, of a global recession. You know, you look at drops typically. I believe the market's down. We're depending on where you're at in time, 20 to 40%. Typically, a bear market is a drop of 38% or more. Well, right now, with where we're a few weeks into this thing. 3, 7, 6, a ton of weeks into this thing. What is it? It's almost it's well over a month on this thing, and we still haven't even necessarily seen the bottom of where we're at. So the problem that we've got to be paying attention to right now is that this thing can continue to still fall. And we mentioned investor psychology. Don't ignore what's going on right now. We also mentioned too asset allocation. If you're not certain of what your asset allocation is, or your advisor says, oh, it's cash, bond funds, and stock funds, that is not enough. We need those things, but we need precious metals, real estate, commodities, treasuries, all these different what are called asset classes that are moving in different directions. The technical term is called non-correlated assets, meaning different things move in different directions. That's why it's so unbelievably important. And what's happening too is you see these drops are so much faster. There's kind of 2 main things that are causing it. But a lot of people ask me recently, why is it going up on these days and why is it going down so fast on these days in the market? Well, there's 2 main components. One of them is what's called high frequency traders. Basically, they're the people that are in between the trade, trying to buy and sell a bunch between a transaction is made in fractions of seconds. That artificially increases the ups and decreases the downs. Also, 2 people have stop losses. Basically, those stop losses say when you get to a certain point in your portfolio, boom, you stop out. Well, the problem with that is that if you continue to get stopped out and millions of people's portfolios are stopped out, what that basically equates to is a situation where you're artificially increasing the supply and you're decreasing the demand by selling it. And at the end of the day, we're an economy of buyers and sellers, so that artificially alters the way the economy is set up right now. So what we've got to pay more attention to is this right here. I'm going to talk about this. This is what's called a stress test. And basically what it is, I'm seeing a lot of questions on the right-hand side from clients. I'll cover all those. If you've got a question on here, I don't have time to get to it right now. We'll be sure to follow up with you here shortly. But if this is a stress test, and basically what it is, it's a risk assessment. What it does, it shows you how much risk is actually in your portfolio. Here's what's interesting. Now, how many of you all have been to a stress test at the doctor's office before? Okay, I'm seeing a lot of yeses come in there. Well, that one answer is inappropriate. I don't think I'm going to read that one. But you go to the doctor with a stress test. They put you on the treadmill. They try to kill you. Okay, so we're going to put your portfolio on the treadmill. We don't want to kill it though. Now, basically what this is, if you look towards the upper left-hand corner, this is showing basically what happened from 2007 to 2009. I want to preface this. When it's all said and done, most all the experts out there, what we're seeing too, this very well could be a drop combination between 2008 Great Recession and 9/11 as a percentage drop. So if you're looking at where we're at in terms of how much more things can continue to fall, we still have a ways to go. I think it's a very reasonable expectation to say we're at the beginning of this, not the end of this. So if we look in the left-hand corner, basically this is showing the time from September of 08 through March of 09. Down there is the outcome. The more important thing I want to stress to you all is the time frame. Please write this down. If you got your phones, do it on your phones or your laptop, whatever you need to do. Market corrections on average take 6 months to a year to go from top to bottom. We're not even that far into that cycle. On average, they take about 7 to 10 years to get back to where we're at. The question everybody out there should be asking themselves right now is, do I have 7 to potentially a decade years of time to get back to where I'm at? If you're outside of 10 years from retirement, if your kids are freaking out or your grandkids are freaking out, I'd tell them to take a chill pill, relax, take a breath. They've got a ton of time. They're going to be more aggressive with their contributions and their 401ks and IRAs. If you are within 10 years from retirement, risk is your biggest enemy, not your friend. If we come down here, if you all look at those numbers where the portfolio impact shows, you can see the current value for this client. At the time, this individual had about $1 million in their portfolio. We ran this scenario for them. Literally, their portfolio is poised to fall by about 48%. So this is basically the time frame. I got a question from Nicole here. Yeah, the time frame again is just showing from 2008 to 2009, that time period, and then also to the time frame ultimately means market corrections take about 6 months to a year to go from top to bottom. They take 7 to 10 years to get back to where we're at. That answers your question, Nicole. But if we go down here, though, at the time they had about $1 million in their portfolio. In this scenario, they were poised to fall by about 48%, meaning they go from $1 million to $500,000. It's a $500,000 loss in your portfolio. You got to ask yourself the question right now out there, is your retirement going to go the way that you want it to? You go through a 50% drop. You start to think, how would that impact the well-being of your retirement? What would you have to cut from your lifestyle? You know, some people say, oh, I want to travel. Well, maybe now you can't fly to vacation, you have to drive, or maybe you can't go to vacation at all. The reason why I illustrate this to you is that if we look at where we're at in the grand scheme of things, with the percentage drop that we've seen in the market, we can still fall a lot more. If you're ignoring what's going on right now, do not try to say, oh, well, it's going to only fall here, then it's going to bounce back. If it goes here, you can't even see it on the frame right now. If it continues to fall, that puts us in a much worse off position, because if you look at that right there, and you go to that portfolio and you see all those holdings that are below, all on the red side, you look at that portfolio right now, what's missing, right? What's missing from the portfolio? Yeah, a bunch of you just typed that. Green. There's literally no green to offset that red. See, the problem is we're talking about asset allocation. People's portfolios need to be allocated in a way where they still have the red. I'm not saying get rid of all your stock funds and your bond funds and your cash. What I am saying, though, is we need green to offset the red. If everything is doing the exact same thing when the market falls, that's why so many people in the time like this, or even 2008, they all said to themselves, like, well, I'm diversified. You're diversified because you have a lot of funds. But if everything's got Apple, Microsoft, Google, Enron, all these Exxon, all these companies, if it all has the same exact investments in the portfolio, they all go in the same direction. And the reason why I bring this up is that if you don't know that number, that 48% I mentioned, if you are not 100% of what the number is in your portfolio right now, and you're not working with us, that is a massive, massive red flag. And the reason why, if you don't know how much risk you have, how can you even know where you want to put yourself? So the reason why I bring this up, now like I mentioned too, we've got offices all over the country. We've probably at this point in the ballgame, I bet run like 10,000 of these stress tests. Be happy to do that for everybody out here. I'm going to go ahead and add this up here. Let me do this real quick. Yeah, if you all look at your side right below the chat, there's an opportunity for you to schedule just a complimentary time for you to sit down and talk with us. Now, we can do things over the phone. If you would prefer a Zoom conference meeting, we've been doing that with tons of people. We've been so unbelievably busy with people just knocking down our doors wanting to visit with us in light of what's going on. If you're home during the coronavirus, you know, Netflix is fun, not every single day for 12 hours a day. You know, get hold of your investments. You know, you owe it to yourself. If you're nearer in retirement, do you really want to go back to work? Or do you want to stay working for another 7 to 10 years? Be happy to do one of those stress tests for you. It's pretty easy. We've got software just like I showed you right there where we can run that and show you exactly how much risk is in your portfolio. Because if we don't know how much risk we have, we're literally flying through, we're flying through the air without air traffic control. And if we're doing that, how can we expect ourselves to have any sort of certainty as to whether or not our retirement is going to go the way it needs to go? So if we come to this next piece right here, the reason why I bring this up, and I want everybody on this to be engaged. And I saw a couple of questions. Yeah, so I had a client ask, you will contact all existing clients. If you haven't heard from us, our entire team is touching base with all of our clients. We've been doing it the last few weeks. If you haven't been contacted at this point in time, we're not as concerned about what you're invested in as it's safer. We're contacting clients right now who have a higher level of risk in their portfolio. That's a great question. Thank you. Also, as I'm going through this too, ask questions. If you got something you want me to talk about, I can try to build it into what I'm talking about. Because if you got a question, Roxanne, great question. If you have a question and someone else doesn't, that will allow us to maybe answer something that I wouldn't have necessarily talked about before. So what we've got right here is just a risk assessment. What this allows us to see is what is the comfort level of risk you want to take in your portfolio. So if we look right here, we have 7 different scenarios, portfolios A through G. As you can see, A is as conservative as you can be, G is as aggressive as you can be. To give you all some perspective, a normal client of ours is between B to D. But if you look, portfolio A in any 1 year says you could lose 5%, but you could earn 10%. Portfolio B says you could lose 8.25%, but you could earn 16.5%. And as we move further and further down the line, we get more and more aggressive. Now, what I want everybody to do is on the chat, type in which portfolio you want to be at. I'm going to start reading out their names. So start typing in the portfolios. Yeah, we'll do a stress test on that, Gary, for sure. I'll get with them on that too. So if you all would go ahead and type in which portfolio of A through G you want to be at. I want to start writing all of this right now. B, A, C. Keep them coming. We got a bunch of people in here, so I want to read out a bunch of them where you all can see the pattern. Okay, A, C, B, B, C, D, C. Notice the pattern too. C, A, B, C, E, B, B. I can't keep track of them all now. But you all saw the pattern. There's a bunch of A's that just came in. So if you notice, most everybody I just named, and there's a bunch still coming in, but most everybody was in between B and D. Why is that important? If you're within 10 years from retirement, that is a smart place to be at. Typically in between a 5 to 10% drop in the portfolio in a worst case, maybe we go to a 15% drop. But the reason why I bring that up, if where you're at right now, yeah, a bunch of A's and B's and C's coming in. Thanks, guys, for keeping engaged on this. This makes this way more helpful for me so I can get some good feedback. But if we look at that, the reason why I bring this up, most everybody's in between A and D. There's a few outliers. I saw a couple, maybe 1 or 2 G's. I saw an E here or there. I don't think I saw any F's. But most everybody is in between A to D. The reason why I bring that up, if you are not a client right now, do you know which portfolio you are right now? And if you say, well, I think I'm B, do you know with an absolute level of certainty which portfolio you are? Because here's the problem. Let's say we want to be portfolio B to D. The vast majority of folks that I meet with are G or lower. And that's because they have stocks, bonds, and cash. Those 3 different types of funds. So the reason why I bring this up is that we need to know where we're at so we can figure out where we want to be. That's why if we come back here, if we're between B and D, a normal person I meet with on this stress test is right around that threshold number. And the problem with that too is that if your worst case is 10% in your portfolio, but you have a 50% loss exposure in your portfolio. See, most of you right now are already at your worst case comfort level in your portfolio. And the problem with that is that if you're, that's a good question. I'm going to read that real quick. Let's see. That's a good question. Eric, I'll talk to you after that. That's a great question, though. I don't want to take too much time from this. But most people don't even know what their risk threshold is, or maybe you've already fallen to C or D in your portfolio and you want to be A or B. The problem with that is we've got to correct course because like I said, right now, it's 1 to 2 years for recovery. If we don't fix it, it could be 7 to 10 years. And that means having to tell people they can't retire. I've been meeting with folks in the office all the time who are coming in for first visits, family members sending people our way. We're very grateful for that. But I've been meeting with people who have been losing hundreds of thousands of dollars in their portfolio. And I'm having to tell them you got to keep working. And right now it's 1 to 2 years. If you ignore what you've got because you're afraid of looking at it, that's the difference between 1 to 2 years and 7 to 10 years. This thing is falling so fast. I know one of my clients on here, Mickey, who used to be a commodities trader. He's probably enjoying this a lot right now. He'll tell you from candlestick analysis, we probably have a lot more to go down at the rate and speed we have because of how long it takes to get back to where we're at. So the reason why I bring that up is we've got to know a few things. First and foremost is time horizon. How long do you have before you retire? If you're within 10 years from retirement, you need to know with absolute certainty which portfolio threshold that you are currently in right now. If you're outside of 10 years from retirement, it impacts you. But I personally like the idea, unless you need to build up your cash account, I like the idea of being more aggressive with your contributions because you're buying through the ups and downs in the market. You're taking advantage of the volatility as opposed to suffering through the volatility. Because the real question is, how long do you have to recover after a stock market correction? Do you have 10 years to get back to where you're at? And if the answer to that is no, like I said, we're more than happy to sit down, do a strategy session, a complimentary visit with you, just to sit in there and talk about where you're at with your portfolio, because we need to make sure that things are in a position of where they need to be. The next level is know your risk or recovery comfort level. That's again to knowing where we want to be here and then where this is. Now, for some clients we have who are more aggressive, they are going to fall lower here, but not for the entire strategy. But the real thing I want to stress again too, whether or not you're a client, or maybe you are a client, we need to get more safety. It's a great rule. So a little while ago, I was being interviewed on live news in Denver, Colorado. And I was sitting down and I was talking to the host of the show. His name was Kirk. And he said, Jordan, you've had the privilege of talking to, thousands of folks every single year. You're a partner with your firm. You teach a class at, DU, University of Denver. You guys have offices all over the country. You all have helped, 5,000 individuals, 3,000 families. When you're meeting with someone or when you're visiting with someone, what is it, or what's the number one? What's the number one mistake that you see individuals are making as they're moving closer and into retirement? And I was really glad that Kirk asked me that question because I knew the answer to it. That's probably one of the most important things that he could have asked me. So I'll share with you what I told him. I said, Kirk, the number one mistake we see folks are making as they're moving closer into retirement is that they're carrying way too large of a percentage of your portfolio tied up in the market where it can fall in value. In other words, there's too much risk. There's too much risk. So Kirk said, okay, Jordan, so what do we do then? Do we take all the money out of the account? Do we stuff it under the mattress? Do we bury it in the backyard? What do we do? I said, Kirk, I wouldn't bury your money in the backyard. It may mold, but something that you can follow, something that we follow very, very closely as a firm. Whether or not to out there, folks, you're the firm for us. I see tons of people who are clients. Yes, our advisory team will reach out to you. I appreciate those words, Gary. Yeah, 7 to 8 years under if we hadn't worked out with SWD. We really appreciate that. I see a lot of you too who are watching this who aren't clients who are like, how do we do the strategy session? Like I'd said, or the complimentary visit, like I'd said, just click on that link. It'll take you to a calendar. We'll get you set up with all of our advisors across the country, wherever you live. We could do Zoom meetings at first, but a rule we can use, which is a great tool, it's what's known as the rule of 100. Please write this down too, some really important takeaway. The rule of 100. Basically what it says is you take your age, right? That's the part of the portfolio that needs to be in investments that are 100% safe and protected. Now, when I say safe, I don't mean it can lose 5% or 10%. Like we've got our most conservative portfolio in investments. We've got other assets that don't lose anything, but our most conservative portfolio, the market's down about what, 30+% at this point in the ball game. It's only down about 5 percentage points. Now you can recover from 5%. You can't recover from 30%. And keep in mind too, just because you take less risk in a portfolio doesn't mean you can't get a good return. That portfolio I'm describing, I'm going to talk about it more in a minute, over the last decade has averaged about a 6 to 8% rate of return. That's outpacing inflation plus some. That's why it's so important to make sure we've got the right mix in our portfolio. So the rule of 100 says take your age. That's the part that should be safe. The number 100 minus your age, that's where we can take some risk. So if you're 60 years old, 60% safe, 40% at risk. If you're 70, 70 safe, 30 risk. If you're 50, 50-50. We got to make sure that we're in alignment with that number, and we don't have to be 100% on the money. You know, if you're a client out there, you know, 5 to 10 percentage points off is okay. I would not go further outside of, you know, 5 to 10 percentage points, especially with what the market is doing right now. Folks, Mark Twain said it best. History doesn't repeat itself, but it rhymes. The stock market sounds like 2008, and it sounds like 2000, and it's going to continue to sound like that. With what is taking place in the market right now, usually at the end of a bear market is the point in time where the sky is falling. Everybody's worried it's the end of modern economics. We're just getting started. The vast majority of the population is still in denial. Or it's like, oh, I'll bet I'll bounce back. Warren Buffett said it best. Yeah, I just saw somebody write that. Just stuck in my memory. Be fearful when others are greedy. Be greedy when others are fearful. And the reason why that's so important right now is that people are still ignoring things. And right now, if you are hearing from your advisor, just write it out. Happy days are ahead. Hold off. It'll bounce back. The stock market will recover as fast as it falls. You may miss out. The problem with that statement is that is the group think that everybody told their clients in 2008, where it took 7 to 10 years to get back. The same group think that they told their clients in 2000, where it took a long time. It doesn't mean you have to cash out your money and put it on the sidelines, but a lateral move protecting you from going. So you started here, you go to here. It's protecting you from going to here. We want to cut those losses as much as we can, because if you're within 5 to 10 years from retirement, risk is your biggest enemy, not your biggest friend. So if we come right here, this is really interesting. I teach this all the time. We teach this in all of our classes across the country that we partner with universities because they want us to teach this. But this is really interesting. Whenever it comes to, and type this in your all's notes, I want to know what you all think. But whenever it comes to you making investment decisions in your portfolio, what are some of the ways that you go about deciding what you want to invest in, right? What are some of the different ways? Looking, performance, company, allocation, company, performance. Yeah, we'll do that to start with. So performance. If you look at these two portfolios right here, on the left-hand side, that's probably your all's right-hand side where I'm on the left-hand side. But on the left-hand side, we have portfolio A. And the right-hand side, we have portfolio B. You look from 2000 to 2018, on the left-hand side, portfolio A averaged a 6.31% rate of return. Now, if you go to the right-hand side, portfolio B averaged over that same period of time a 6.29% rate of return. I like that answer. Which fund has the coolest name? We don't want to do that. That's funny. It's a good answer. Y'all made me laugh out loud in a webcast. Okay. So the left-hand side is portfolio A, 6.31% return. The one on the right-hand side is a 6.29% return. Now, if you were basing your decision just off of that fact, which portfolio would you choose? If it was just off of performance, which one grew more? Which one would you choose? Yeah, of course, you'd choose portfolio A. And the reason why 6.31 is 6.29. Now, I know none of you have ever done this before, but obviously we know that's not enough to base our decisions off of. Again, we have to have which fund has the coolest name. So the one on the left-hand side, what are some other ways we go about making decisions in our investment portfolios? Yeah, I see company a lot, and I saw that before. Company, yeah. So the one on the left-hand side is Vanguard, and it's actually the Vanguard 500 fund, which tracks the S&P 500. And the one on the right-hand side is called the All-Weather Portfolio. Now, again, it's got a bunch of different non-correlated assets, stocks, bonds, precious metals, real estate, annuities, dividend-paying stocks, all these different asset classes and groups. If you were basing your decision off of which company would you choose, which one would you pick? Yeah, you'd choose Vanguard, of course. Everybody knows the name Vanguard. Here's what's interesting. And don't get me wrong, we use Vanguard for our clients whenever it's appropriate. But I saw that, Judy. Yeah, we'll touch base with you soon. Yeah, for sure. But if you look at the two different portfolios right there, does anybody know what Vanguard did? I'm going to write that down real quick. Does anybody know what Vanguard did to their late CEO and founder, Jack Bogle? They fired him. They fired him. You want to know why they fired him? He was so, and don't get me wrong, he was so unbelievably instrumental in getting fees lowered for the consumer. They fired him because he didn't fit in with their board of directors. So here's the stigma. A lot of you right now who are sitting out there, maybe you have an advisor or you don't, are thinking to yourselves, well, if you don't, well, I know my fees are lower. And the stigma oftentimes is it's less expensive to do it myself. I meet with people all the time in the office when it's all said and done with all the fees and cost and their mutual funds and their IRAs and 401ks. It's oftentimes less expensive to have a professional do it as opposed to doing it on your own and paying so much money. So again, they talk about fees and they talk about it and it's well known for it, but it doesn't have that tremendous of an outcome. Now, obviously, you guys know we can't base our decisions solely off of those three things, right? Company, performance, fees. We've got to know more. Now, I'm going to teach you all a little bit of Wall Street math. If you look at those two different portfolios, the one on the left-hand side and the one on the right-hand side, and I'm seeing it on the thread, Mickey, I see you right there. What do you notice that's different about those two different portfolios? Like, what do you see that's different about those two different portfolios? Yeah. When Vanguard is good, it is really, really good. When it's bad, it's horrible. 2000 to 2002, 40+% drop. 2008, 37% drop. How we earn our returns in the portfolio is big ups and big downs. It's super volatile. Yeah, it's fluctuations in returns. The one on the right-hand side, the more conservative one, if we look at those different time periods, it never loses more than 5.44% in a year. It's way more conservative. Oh, write this in your notes too. I'll come back to this in a minute. The one on the left-hand side for Sharpe Ratio, write 0.35. The one on the right-hand side, write 0.95. I'll come back to it in a minute. So left-hand side, 0.35, right-hand side, 0.95. But I'm going to teach you all, we put some money to the math, and you go to this next piece right here. This is really interesting. Same exact portfolios, Vanguard, all weather, 2000 to 2018. Now let's plug in $1 million. You go from 2000 to 2003 with the Vanguard strategy. You go from $1 million to $622,000, 400 grand in 3 years. You're starting to sweat a little bit when you see that. We go to 2008, phenomenal growth. We get back to $1 million, and boom, 2008, 2009, it falls to 700 grand. We go through that 18-year time period, and that portfolio is worth $2.4 million. Objectively speaking, still a good portfolio. It doubled plus some. Here's what's interesting. You go to the all-weather strategy. Lower return, 6.29 versus 6.31, right? Lower average return, $1 million. We get to the end of the road, 2018, $3 million in the portfolio. Same return, $600,000 difference. Is that a significant amount of money? Is that going to impact your retirement? What could you do with an extra $600,000? A lot. And you start to look at those types of things and you see that big losses can absolutely kill you in retirement. That's a $600,000 difference. That's a good nest egg for a lot of people. And that's literally how much someone lost in their portfolio. Here's what's interesting though. Most everybody on here, I know we have a lot of clients, kiddos and grandkids, but most everybody on here has folks or is going to take money from their accounts at some point in the future, right? Safety, volatility, protection. Here's what's interesting. Let's throw in some income now because you're going to want to pull money out of your accounts in the future. Same portfolio, 18-year time period. Let's take a $50,000 withdrawal, about 5% of what the account's worth. So 2000, 2018, same 18-year time period with $50,000 withdrawals. In an 18-year period, it's worth $1 million. Starts with $1 million. It's $306,000. Is that a good portfolio in retirement? Is that going to be successful? Are you going to have a good retirement? If you look from 2000 to 2003, 4 years into retirement, which a lot of people are going into retirement right about now, 4 years into retirement, your portfolio is worth half of what it was whenever you started. The probability of success is almost nothing because you can't recoup the losses early on. We go to the all-weather strategy. Same 18-year time period at the end of the road to save time, $1.3 million. It's literally what you put in plus the other plus portfolio A. Is that $1.3 million? Is that a significant difference between the two? Which one do you want now? See, here's the thing. When you're not taking income in retirement, it matters some. It doesn't change things fully when you're not taking income. But when you are taking income in retirement, that is all that matters, is not losing money. If you're outside of 10 years from retirement right now, you really don't need us that much. You don't. If you're within 10 years from retirement, do you really want to risk losing almost all of your retirement nest egg because of volatility in the market that is outside of your control? Because here's the thing, like, I don't need to plug in everybody's portfolio, theirs next to the all-weather. I only need to know one number. What is that number in the portfolio that I need to know? Sharpe ratio. Everybody write this down. This is one of the biggest takeaways today. The stress test and the Sharpe ratio are the two biggest takeaways for today. What is it? Sharpe ratio dictates how efficient is your portfolio. It simply means, is your portfolio efficient or inefficient? Remember, the one on the left-hand side, the Vanguard strategy, 0.35. The one on the right-hand side, 0.95. The rate of return and the order in which we get returns for the Vanguard strategy is very inefficient. Big ups, big downs. The all-weather is much more conservative and steady. We're not trying to hit home runs, because if you try to hit a bunch of home runs, you're going to strike out. If we go for singles and doubles, that puts us in a much better position. And again, Sharpe ratio, anything around 1% is good. 0.9 or above is acceptable. Most everybody, I don't even need to look at your portfolios. The vast majority of the time, anybody I meet with in the office, their Sharpe ratio, if they're lucky in their IRAs, 401ks, mutual funds, but their stock funds, bond funds, and cash, they're lucky if their Sharpe ratio is around 0.5 net of fees. They're lucky. That means you have half of the efficiency you need to have in your portfolio. So why should you be surprised when the market free falls if your money is free falling? That right there, folks, that is literally the secret to investing. Now, we've got software in the office. We pay thousands of dollars every month to be able to use to run the Sharpe ratio. It's one of the first things we look for. I would put money, if anyone who's not a client of ours has probably never heard of the Sharpe ratio before. And if you haven't right now and you've got an advisor you're working with, you've seen big drops in the market, they've told you to run the course. Yeah, Tim, slow and steady wins the race. I love it. You got the right thinking. If you're not hearing those types of things from your advisor, or if you're having experiences like that, just ride it out. Happy days are ahead. It'll bounce back. You're in it for the long haul. Market is going to go back. Your advisor is telling you loudly and clearly it's time for you to reevaluate your situation. If you haven't already done so, I know most all of you, I think I saw a bunch of you already checked off on the stress test. You want us to do that. We'll be calling you. Like I'd said, I know you all can book times for different locations around the country. As well as that, too, keep this into perspective also. You also got to keep in mind this. The Sharpe ratio dictates how much risk we typically have in our portfolio based upon the returns. So these two are hand in hand. When we run the stress test, we always look at the Sharpe ratio. Go ahead, set a time for you to do a visit with us. Again, we'll do it over the phone or via Zoom. You got no excuse right now, guys. Whether or not we're a firm for you, it's become much more than a business. It's a mission right now to save as many people's retirements as possible. We're unbelievably busy right now. I mean, we don't have room for everybody today, but we'd love to be able to help you run this analysis so you can see where you're at. It's not over yet. Do not ignore what has taken place in the market. If you're doing that, you are setting yourself up for success. So whenever you click that for the let me pull it up again. I believe we already have it up. Yeah, schedule your time with us. Click that. It'll take you to a link, and then we could do that for you. Again, if you don't know this numbers right now, you're setting yourself up for failure. That's why this is so important. So if we go here, you see we already went over that. That's not as important as what else we covered. Yeah, so folks, that's everything for right now. I hope this was super valuable for you. If you're a client, I saw a couple of you on here say, hey, can your advisor touch base with us? Like I said, we are calling everybody, but anybody who's been on this webinar, we'll put you at the top of that list just to where, we're reaching out to everybody as soon as we possibly can. So folks, thank you all so much for your time today. You all were awesome. Thanks for being so interactive. Like I said, click at time to visit. If you're sitting at home quarantine, you might as well get your retirement as under control as it can be, because it's not if, it's when. and it's going to continue falling. So thank you all so much. You all were great. A couple people made me laugh out loud. We'll see you all soon. Again, love to talk with each and every one of you. If you're a client, we'll touch base with you. If you're not a client, I would strongly suggest talking with us. We'd be more than happy to. Whether or not we can help you, we at least want to point you in the right direction with what's going on. So thank you all so much, and I'll talk to you all soon.